Okay, so when trading the markets, there's really only going to be two ways in which you exit a position. You're either going to exit a position as a losing trade and you don't make any money, or you're going to exit a position winning. So there's two types of ways. Now, how do we actually define those exits? In the previous chapter, I talked about initial stops, and an initial stop is effectively how we exit from a non-profitable trading situation. It's how we limit our losses. It's how we stick to the age-old rule of cutting your losses. Now we need to talk about what do we do in a profitable situation. We need a way to make sure that we lock profits in as the share price goes up. So if it then reverts down, we don't hold it all the way back down to zero. We get out at a point locking in some of those profits. To do that, we use trailing stop losses. And again, it's another way to stick to the age-old trading rule of letting your profits run. I suppose the real key here is, like lots of things in your trading plan, the real secret, if you will, is to just have something in place. You see, most people don't have something in place. All you have to do is look back to the tech boom in 2000, and if you open up any chart, the story is pretty much telling the same thing. You would have seen the chart go up massively and there was a huge run up and then it just drops down on the other side. And what a lot of people did in that tech boom, and any boom for that matter, they'll usually write it up on the way up and they're all excited and there's so much elation because they're making so much money. Then it starts to turn down. They don't know what to do. They don't have any predefined exit points or way to lock in that profit, and then they just go all the way back down to zero. And we need to put some systems in place so that doesn't happen to you. Personally, as I said, I like that age-old trading rule of letting your profits run. So I personally don't like profit targets. I know there is a time and a place for setting profit targets. That is a point at which you go, oh yes, once the share price gets up to here, then I'm going to exit. For me personally, I like to wait for the share price to go up, and then once it falls back, I get out at a point once it's retraced off the high. And the reason I do that, I know I'm never going to pick the top, but I like to make sure I hold on to my winning trades. That said, obviously I need to put that disclaimer that there's plenty of ways to make it work, and really you're just going to be head and shoulders above everybody else if you have something in place. And certain instruments do require that you trade with profit targets. It just doesn't work for me. You need to find what's right for you. Personally, I like the lowest low stop, and all the lowest low stop does is it looks for the lowest low in the last X number of periods, where X you define based on the time frame at which you're trading. Now, I know that might be sort of a little bit heavy going, and more of it's explained down on this page so you can find out a little bit more. The long and the short of it is that you need to come up with a mechanical way in which you process your exits. Out of everything to do with trading, I think having your exits as mechanical and robot-like as possible is probably one of the keys to making sure that you're going to stick with them. So go ahead, find out what exit works for you, and most importantly, write it down and have something in place. And I'll see you on the next chapter.